Inflation era overview. High inflation becomes an everyday reality, and what used to be rare suddenly turns into something people experience constantly. Prices no longer stay the same for months or even weeks, but begin to change rapidly, sometimes within days. This creates a sense of instability because people cannot predict how much things will cost in the near future. Uncertainty spreads through society, affecting not only financial decisions but also emotions and long term planning. In this environment, traditional savings lose their meaning, and people start searching for ways to protect what they have. Gold slowly emerges as one of the most important assets, not because it is new, but because people rediscover its role as a stable store of value. Daily life changes. Fuel shortages and long lines become a visible symbol of the crisis. People wait for hours just to fill their cars, unsure if there will even be enough fuel left when their turn comes. Inside stores, prices are constantly being updated, and customers notice that the same product costs more each time they visit. Purchasing power declines, meaning that even though people earn money, it buys less and less over time. Families are forced to make difficult decisions, cutting back on everyday items and postponing plans they once considered normal. This shift affects not only consumption, but also confidence in the future, as people begin to feel that their financial stability is slipping away. Gold awakening. As the situation worsens, people begin turning to gold. What was once seen mainly as jewelry starts to gain a new meaning. Individuals who never considered buying gold before now see it as a form of protection. Gold becomes more than an object of beauty, it becomes a tool for preserving wealth. This shift in perception is powerful because it reflects a deeper change in how people think about money and security. In times of uncertainty, owning something tangible and universally valued provides a sense of control. Gold represents stability in a world where everything else feels unpredictable, and this realization marks the beginning of its renewed importance. Oil shock impact. The embargo causes a sudden and dramatic increase in oil prices, and because oil is deeply connected to nearly every part of the economy, its impact spreads quickly. Energy becomes more expensive, which means transportation, production, and even basic goods cost more to produce. This chain reaction destabilizes the entire economy. What starts as a problem in energy markets quickly turns into a broader economic crisis. Businesses struggle to manage rising costs, while consumers face higher prices in almost every area of daily life. The shock is not gradual but immediate, leaving little time for adaptation and forcing governments and individuals to respond under pressure. Stagflation emerges. At the same time, a new and unexpected economic phenomenon appears: stagflation. High inflation is usually associated with economic growth, while unemployment is linked to downturns, but now both occur together. This creates confusion because traditional economic theories do not fully explain the situation. People find themselves paying more for goods and services while earning less or even losing their jobs. The combination is especially difficult because it removes the usual solutions. Stimulating the economy risks increasing inflation further, while controlling inflation can worsen unemployment. This paradox makes the crisis more complex and harder to manage. Government measures. Governments respond with various measures, including speed limits, reduced work schedules, and campaigns encouraging energy savings. While these actions aim to address the problem, they often fail to produce the desired results. The measures can slow down certain aspects of consumption, but they do not solve the deeper structural issues in the economy. As a result, frustration grows among the public, who expect quick improvements but instead see limited progress. The gap between policy intentions and real outcomes becomes more visible, highlighting the difficulty of managing such a widespread and interconnected crisis. Policy responses. WIN program promotes saving, and it represents an attempt to solve an economic problem with a behavioral approach. Governments encourage people to spend less, conserve energy, and act responsibly, hoping that collective discipline will reduce inflationary pressure. At the same time, governments introduce price controls to limit how much businesses can charge for goods. Central banks also step in, trying to reduce demand by tightening monetary policy. On paper, these responses appear logical and coordinated. However, they rely heavily on public cooperation and assume that expectations can be easily managed. In reality, economic behavior is more complex, and people react based on what they believe will happen next, not just on official instructions, economic consequences. Empty shelves and black markets begin to appear as unintended consequences of price controls. When prices are artificially kept low, suppliers lose the incentive to sell, leading to shortages. Goods that are difficult to find in official stores often reappear in unofficial markets at much higher prices. Businesses, anticipating future cost increases, raise prices whenever they can, even before their own costs go up. At the same time, workers demand higher wages because they expect prices to continue rising. This creates a cycle where both sides try to protect themselves, but in doing so, they reinforce inflation. Instead of stabilizing the economy, these reactions contribute to further instability and uncertainty, loss of purchasing power. Money loses value in a very real and visible way. Households notice that their income no longer covers the same expenses as before, forcing them to adjust their lifestyles. Items that were once affordable become luxury purchases, and even basic necessities start to feel expensive. Saving money becomes a burden rather than a benefit, because the longer cash is held, the less it is worth. This shifts behavior dramatically, as people prefer to spend quickly or invest in assets that might retain value. The psychological impact is significant as trust in money weakens and financial planning becomes more difficult. People begin to question the stability of the entire economic system. Gold as safe haven. Gold no longer holds the status of official money, yet it rises in importance as a protection against inflation. As its price increases sharply, it attracts attention from individuals who are looking for stability in an unstable environment. The rise in gold's value is not just a market phenomenon, but also a reflection of growing uncertainty. People are not only buying gold for profit, but for security. It becomes a place where value can be stored without relying on governments or financial institutions. This shift highlights how quickly perceptions can change when confidence in traditional systems declines. Why gold matters. Gold cannot be printed, which makes it fundamentally different from paper money. Its supply is limited, and this scarcity gives it a sense of reliability. It is also globally recognized, meaning it can be accepted and valued anywhere in the world. This universal acceptance makes gold a practical asset during times of crisis. Additionally, gold is easily tradable, allowing people to convert it into cash or goods when needed. These characteristics combine to make gold uniquely suited as a store of value. In uncertain times, these qualities become even more important, reinforcing its role as a financial anchor. Human stories. People's experiences bring these concepts to life. Some individuals who previously had no interest in gold begin buying it as a form of security. For them, it represents peace of mind in a time of uncertainty. At the same time, other families are forced to sell their gold to cover essential expenses such as heating or food. These contrasting stories show that gold serves multiple roles. It is both a form of protection and a source of emergency funds. It acts as a financial reserve that can be relied upon when other options are limited. Through these personal experiences, the importance of gold becomes clear in a way that numbers alone cannot explain. Silver speculation. Hunt brothers buy silver, and their actions quickly draw attention across financial markets. Instead of treating silver as a stable store of value, they approach it as an opportunity for massive profit. Prices begin to rise rapidly as demand increases, fueled not only by their purchases, but also by growing interest from other investors who do not want to miss out. The market becomes increasingly unstable as more money flows in based on expectations rather than fundamentals. This creates a situation where prices are driven by momentum and speculation rather than real economic value. What starts as a strategic investment gradually turns into a widespread frenzy. Silver collapse. Silver Thursday triggers a dramatic crash that exposes the risks of excessive speculation. As margin requirements increase, investors are forced to provide more collateral to maintain their positions. Many are unable to meet these demands, leading to a wave of selling. Prices fall rapidly, and the market that once seemed unstoppable suddenly collapses. Investors lose significant amounts of money, and some see their life savings disappear. The situation spreads beyond individuals, affecting brokers and financial institutions as well. The event becomes a powerful example of how quickly markets can reverse when they are built on unstable foundations. Lesson learned. The difference between safety and speculation becomes clear through this experience. While assets like gold can serve as protection, speculative behavior introduces significant risk. Markets are inherently volatile, and even assets that are considered valuable can experience sharp price swings under certain conditions. This teaches an important lesson about financial discipline and the dangers of following trends without understanding underlying risks. Investors begin to recognize that not all opportunities are equal, and that the promise of high returns often comes with equally high dangers. The story of silver serves as a warning that emotional decisions in finance can lead to serious consequences. Europe's responses. Germany protects its currency by maintaining strict monetary discipline, focusing on controlling inflation and preserving trust in the Deutsche Mark. This approach reflects a strong cultural emphasis on financial stability and long-term thinking. In contrast, the United Kingdom faces a deep economic crisis marked by high inflation, labor disputes, and declining confidence in its currency. Switzerland remains stable, benefiting from a strong financial system and cautious policies that keep inflation low. These differing responses show how national strategies and historical experiences shape economic outcomes during periods of global instability. Southern Europe. High inflation levels affect countries in Southern Europe more intensely, creating additional pressure on households and businesses. Families respond by investing in tangible assets such as real estate, which they believe will hold value better than cash. Gold and foreign currencies also become popular choices as they offer protection against the weakening of local money. This behavior reflects a practical adaptation to economic uncertainty, where people prioritize preserving wealth over traditional saving methods. The need to hedge against inflation becomes a central part of everyday financial decision-making. Currency differences. A strong franc attracts capital as investors seek stability and security in uncertain times. Switzerland benefits from this inflow, strengthening its financial position even further. On the other hand, a weak pound creates ongoing challenges for the United Kingdom, making imports more expensive and increasing inflationary pressure. These differences highlight how currency strength can influence economic resilience. Discipline in monetary policy often leads to better outcomes, while instability can amplify existing problems. The contrast between countries demonstrates that while inflation may be global, its impact and management are deeply influenced by national choices. Business adaptation. Companies use futures contracts as a way to manage uncertainty in prices. Instead of reacting to changes after they happen, businesses begin locking in prices in advance, reducing the risk of unexpected costs. Currency hedging becomes another essential tool, especially for companies involved in international trade. Exchange rates can shift quickly during inflationary periods, and without protection, profits can disappear overnight. Businesses also start adjusting their pricing strategies more frequently, responding to market changes in real time. This marks a shift from stable, predictable operations to a more dynamic and defensive approach, where survival depends on managing risks rather than simply maximizing growth. Financial innovation. The growth of options and derivatives reflects the increasing complexity of financial markets. Banks and financial institutions begin offering new instruments that allow companies and investors to protect themselves against various types of risk. What starts as relatively simple tools gradually evolves into more sophisticated products. Finance becomes more complex, requiring deeper knowledge and understanding from those who participate in it. This transformation is driven by necessity, as traditional methods are no longer sufficient in an unstable economic environment. Innovation in finance becomes a response to uncertainty, providing new ways to navigate unpredictable conditions. Goal of stability. The primary goal for businesses and investors becomes predictability. In a world where prices, interest rates, and currencies can change rapidly, being able to forecast outcomes even partially is extremely valuable. Risk reduction becomes a central focus, influencing decisions at every level of operation. Companies invest time and resources into understanding financial tools that can help them maintain stability. New financial instruments are not just optional advantages, but essential components of modern business strategy. This shift highlights how deeply inflation and uncertainty reshape the way organizations operate and plan for the future. Crisis of confidence. Carter warns about a crisis of trust, emphasizing that the problem is not only economic but also psychological. He calls for discipline and responsibility, urging people to change their behavior in order to stabilize the situation. However, despite these efforts, inflation continues to rise. This disconnect between leadership messages and real-world outcomes weakens public confidence even further. People begin to question whether the situation is truly under control, and this doubt spreads across society. The idea of a crisis of confidence captures the deeper issue. When trust is lost, it becomes much harder to restore stability. Psychology of money. Expectations play a powerful role in shaping economic reality. If people believe that prices will increase in the future, they act in ways that make those increases more likely. Businesses raise prices in advance, and workers demand higher wages before costs rise further. This behavior creates a self-reinforcing cycle where inflation feeds on expectations. Money is not just a tool of exchange, but also a reflection of collective belief. When that belief weakens, the value of money becomes unstable. Understanding this psychological dimension is key to understanding why inflation can be so persistent and difficult to control. Public reaction. The loss of trust in the economy leads to growing uncertainty among the public. People become more cautious, changing how they spend, save, and invest. Long-term planning becomes more difficult as the future feels unpredictable. Economic pressure increases, affecting both individuals and families. Decisions that once seemed simple now require careful consideration. This shift in behavior reflects a broader transformation in how people interact with the economy. The crisis is no longer just about numbers, but about confidence, perception, and the ability to believe in stability again. Volcker's strategy. Interest rates are sharply increased as part of a deliberate and aggressive strategy to fight inflation. Instead of trying to manage the problem gradually, the focus shifts to controlling the money supply directly. This approach represents a clear break from previous policies, which were often more cautious. By allowing interest rates to rise to extremely high levels, borrowing becomes more expensive, reducing spending and slowing down the economy. The goal is simple but difficult. Reduce inflation by limiting the amount of money circulating in the system. This strategy requires strong commitment, as its effects are immediate and often painful. Economic pain. High unemployment becomes one of the most visible consequences of this policy. As borrowing costs rise, businesses cut back on investment and production, leading to job losses. Protests and public dissatisfaction increase, especially among groups that are most affected, such as farmers and industrial workers. Entire industries begin to decline under the pressure of reduced demand and higher financing costs. The economy enters a recession, and for many people, the short-term impact is severe. This period highlights the difficult trade-offs involved in economic policy, where solving one problem can create others in the process. Result of policies. Despite the hardship, inflation eventually begins to fall. The reduction in price increases restores a sense of stability to the economy. Over time, confidence slowly returns as people see that the strategy is producing results. The long-term benefits become clearer even though the immediate costs were high. This moment demonstrates that controlling inflation often requires decisive and sometimes unpopular actions. The success of these policies lays the foundation for future economic stability, showing that consistent and credible measures can rebuild trust in the system. Return to stability. The 1980s bring a period of stabilization after years of economic turbulence. The dollar strengthens, reflecting renewed confidence in the financial system. Inflation decreases, allowing prices to become more predictable and manageable. This transition marks the end of an era defined by uncertainty and the beginning of a more stable economic environment. While challenges remain, the overall direction is positive, and both individuals and businesses begin to regain a sense of normalcy. The lessons learned during the crisis continue to influence decisions moving forward, changing investments. Investors return to financial markets with renewed confidence. As stability improves, stocks and bonds become more attractive again, offering opportunities for growth and income. Gold, while still important, loses some of the attention it received during the peak of the crisis. It remains a form of protection, but no longer dominates headlines. This shift reflects changing priorities as investors balance the need for security with the desire for returns. The diversification of investments becomes more common as people seek to manage risk while taking advantage of new opportunities. Key lessons. Inflation is revealed to be deeply psychological, driven not only by economic factors, but also by expectations and behavior. Gold proves its role as a tool for preserving value, especially during times of uncertainty. At the same time, the experience shows that crises are not unique events, but recurring challenges that economies must face. The importance of preparation, discipline, and financial understanding becomes clear. These lessons remain relevant beyond the specific period, offering guidance for navigating future periods of instability